on our estimates, the markets are now pricing in flat earnings for next year. They're pricing in maybe down 10% in the world ex the US. But what worries me is that they're pricing in, I think, plus 3 or 4% in the US. Now, that doesn't make sense given that we've got the US falling into recession in the second half of next year.
Rob, there are times when Citi over the years has been a bit bearish. Like the COVID rally, a lot of you and the team were fairly bearish. Is there a fear that you're actually just kind of a little bit too bearish at the moment and you're misreading the potential growth opportunities, especially in the States?
Yeah, I mean, what happened after COVID, and we had to change our view, you're absolutely right. What happened after COVID is such a super aggressive response by the authorities, both in fiscal and monetary terms. That just isn't going to happen this time round, given the inflation profile. So I think if you wanted to be bullish, what you would just say is that equity markets are just about interest rates, nothing else. So interest rates went up this year, be bearish. Interest rates will peak next year and then start going down maybe later next year, then be bullish. I think equity markets are not just about discount rates. I think they're also about profits. And I think next year, the profit environment will be tough. The interest rate environment will be not anything like as supportive as it was post-COVID. And therefore, I think it'll be trickier for markets and we won't see the kind of rebound that you did see back in 2020.
I hear what you're saying, Rob. Rob, let me come at this from a different point of view as well. There are a lot of assets out there I wouldn't touch with a barge pole at the moment. And a lot of them are in the private sector because I'm very, very worried that actually non-public markets are just not revaluing assets at the right level. And that includes a whole tranche of bonds out there as well. I think a lot of people have had a bruising experience dabbling with some of these meme stocks. I think they've had a bruising experience with crypto as well. And so it's almost well, what do I go to where I'm going to get a decent bit of yield and potential bit of safety as well? And I wonder if blue chips start actually fulfilling a few of those blocks, i.e. we have had a revaluation on blue chips, albeit not as much as you think may well be necessary as well. Is it that actually blue chips have got a safety angle to them, a safe harbour angle to them compared with a lot of other things out there?
Well, you were talking about the UK earlier. I like the look of UK blue chips. This is a market that's lagged the US for years. This is a market that trades on 9 or 10 times earnings compared to the US at nearer 15, 16 times earnings. So I quite like the idea of hiding in blue chips in the UK, but you've got to be careful where you buy your blue chips.
We were just chatting, you will have heard us, I think, having a conversation about ABB and how the FTSE chart seems to have turned with the currency. What's your projection on where we are on currencies then through the rest of next year? Because it seems there are a lot of people are buying back into the UK, into Europe and into emerging markets on the hope the dollar has peaked.
We've got the dollar rally getting back on in the new year, but then fading later in the year when it becomes clear that the US economy is slowing down. I think the dollar got overbought. Trades do that, and it's clearly coming back from that. But some of the underlying themes that have been supporting the dollar, we think can carry on supporting it for the first few months of next year. But let's say over the next 12 months, we would be dollar bears, but not right now.
Rob, I was over at Goldman's the other day, sorry to mention them, and we were talking about the revenge of the old economy and all that kind of stuff that Jeff Curry and others were talking about as well. I think your comment about sectors is really interesting. I want you to expand upon it for us if you can. You are saying, and I'll just pull from your report, 7 out of 10 sectors are currently discounting EPS below analysts' consensus, but only 2 of these, materials 41% down and energy negative 38%, are pricing in a meaningful downturn. More tech-related sectors are all discounting better news than the analyst consensus. Why don't you expand upon that for us? Because I think it's really interesting what is in the price in terms of sectors and what isn't.
Well, you were talking about the oil price falling earlier. I think all stocks are set up for the oil price to fall. That's one of the reasons why when the oil price falls, maybe the oil stocks don't fall as much. Oil stocks don't necessarily, your viewers need to understand that oil stocks don't necessarily price in spot oil. My analysts always tell me they price the oil curve looking out, and the oil curve looking out has generally been bearish for most of this year. So what I would say is that the oil price might be coming under pressure, but oil stocks have already got quite a negative oil price priced into them, and that's what our model is reflecting there. So one of the recommendations I've made to clients is that if you are worried about a downturn next year, obviously buy defensive stocks, healthcare, consumer staples, those sorts of things. But actually also at the other end of the barbell, maybe hide in some of the really, really cyclical stocks, with commodity stocks being the most obvious ones, because they're already discounting as you say, maybe 30–40% off earnings.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.